Morning, JP.
Good morning, Brandon.
Yesterday, I went for a bike ride and I stopped for a non-alcoholic beer.
Okay.
Guess how much it cost?
I don't know. In this economy, like $8.
$11.
$11.
$11
with tip.
With a $1 tip. It wasn't like I was super generous.
Yeah, thanks. May as well give you a poke in the eye.
Yeah.
$10 for something that doesn't even give you a buzz.
So I couldn't decide, are we going to talk about inflation or liquidity with this beer?
Yeah. Got it.
So we're going to go liquidity, and I got some notes here for you.
Sure thing.
First, we need to define liquidity, and I want to level set it for everyone.
Definitely.
The quickness you can sell an asset. That's liquidity. How quick can you sell an asset? So it's really much a game of supply and demand. If there's high demand for an asset, everybody wants it, and there's a high supply of it, there's a lot of liquidity.
Right.
Think of a public market stock, Google.
Mm-hmm. Sure.
The opposite, low liquidity, is when there is low demand for a product and a high supply.
Mm-hmm.
Right? And so that also brings into talk about volume and depth. And I'm looking at my notes.
No,
forget my notes.
Forget your notes.
This doesn't work. Let's just go off the cuff like we always do.
You're good. No worries.
How does instability in the markets impact liquidity?
Yeah, sure. So first and foremost, when there's instability in markets, the way we think of them, big public markets, that typically means things go down, right? Instability and uncertainty are different because right now we have a lot of uncertainty and the market's slightly down year to date, but things haven't really gone off a cliff. Instability is a structural term, right? There are forces at work that are not working the way they're supposed to.
Tell me those forces in supply and demand.
Sure.
What's happening in supply and demand that would make with instability? What do we have a high supply of?
Yeah, like right now we have a really high supply of money.
Yep.
Right? And I don't mean like everyone has a lot of money, because that's actually not true. But we have a lot of money in the market.
In the
right
system.
now, in the
entire system. There's lots of money out there.
Right. And so one of the issues that caused was because we have a lot of dollars, we have a high supply of money to go purchase things.
Mm-hmm.
And we have a limited supply of things you can purchase, we saw inflation.
Yep.
Right. A great example is eggs. Everyone wants to talk about egg prices, like, oh, is this going to fix the egg prices? Well, we had the worst epidemic of bird flu ever in United States history.
Right, great example.
Right. 200 million chickens were euthanized to stop bird flu. 200 million chickens make a lot of eggs. And so what you have is everyone's collective grocery budget going after the lowest supply of eggs we've ever had.
Everybody loves eggs, low supply.
Yes. And so all of a sudden, the cost for those eggs, not only because the farmer has to recoup the cost of killing 80% of their chickens, but also because there's just a natural supply and demand curve. More money you want something, the price of that something is going to go up.
So that causes inflation.
Mm-hmm.
When there's instability in the markets and people get afraid, it's the opposite. Everyone's selling.
Yes.
So there's a high supply of sellers and very low supply of buyers.
Yep.
And stock prices come down, market prices fall.
Exactly. So, in one example, we had going and buying like groceries. Everyone has a high supply of their grocery budget and a limited supply of groceries.
Yep.
In the terms of when people were selling in the market, people don't feel like they have enough cash at home and they want to protect themselves. So they go for the door. And like you said, there's not enough buyers. The supply and demand would dictate that stock prices or bond prices, whatever the asset is, will go lower.
The biggest financial crunch and financial shock or liquidity shock, probably in this country's history, but definitely in our lifetime, was 2008.
Yeah.
What happened with liquidity then? Because that was a recession caused by liquidity.
Yes.
It was not liquidity caused a recession.
Mm-hmm.
It wasn't a recession and then, we have no liquidity. So what happened to liquidity that caused a recession?
Yeah, I mean, ultimately, too much money was tied up in too many illiquid assets. And so a great way to think about it is too many homes were bought with too few dollars, with too much leverage.
Yes.
Right? So there are too many loans out there. And once there was a structural issue with people being able to afford those loans, it basically created a chain reaction where all of a sudden people say, okay, well, look, I have a bunch of mortgages on my book as a bank, right? I helped fund out mortgages.
Yeah.
And people aren't paying them back. So I need to go repossess their house.
Yeah.
Well, now you have a bunch of houses on the market. And as we know, anytime you have an increase of supply of something, the price is going to go down. Well, that spiraled out of control to where all of a sudden, because of derivatives, because of, just kind of everyone was in on that hot housing market, what we saw was a massive wave of repossessions of homes. And all of a sudden, the market for available homes got flooded by banks who don't want these things. They're just trying to sell them as quickly as
I
possible to
remember.
generate cash and fund their obligations. So from there, it spiraled out of control. And it's the same thing. Eventually, the government stepped in. They'll provide some liquidity so that the banks didn't have to keep selling. Because if no one came in to provide that capital, provide some stability, banks essentially would just have to keep force selling until everyone has enough money to cover their obligations. That could have gotten really ugly.
Yeah, so a lot of people owed a lot of money
Yes.
based on a debt, based on a asset that they thought was liquid,
Yes.
homes, that
Yeah.
was not liquid.
Yeah.
And then it's like, okay, well, fine. So a bunch of people had homes, but then they created debt on those homes and all the
Yes.
different mortgages, and then they sold the mortgages
Sure.
to mom and pops.
Mhm.
And you know, we've been selling mortgages to mom and pops forever, but it was like
Sure.
the underlying veracity or
Yeah.
authenticity of those loans, the
Yes.
integrity of those loans,
Went away.
they never existed.
Right.
They were just went away when they
Yeah.
were just really bad loans to begin with.
Yeah, exactly. And so there's another definition of liquidity in terms of like big capital markets like that you and I had listened to earlier, which was it is basically your ability to continue to loan out money, right? And so we know that when you want to buy a house, you go to a bank, you get a mortgage, they
Got it.
loan you money, use that money to buy an asset, and all of a sudden you're me and you're terrified of your mortgage every month.
God
because,
willing. God willing, you can do that.
Exactly. And so, if the bank has room in its balance sheet to keep
Mhm.
lending out mortgages, everything's great. If something structurally changes where that's not true, whether that's a bank or the government or individual corporations, all of a sudden you start to see liquidity with their ability to loan creates liquidity. They send out money into the market. When that dries up, some weird things can happen. Sometimes it can end horribly, right? Sometimes it can really not be that big of a deal at all. Silicon Valley very famously had
Silicon Valley Bank.
Silicon Valley Bank, yes, collapsed a couple years ago.
I remember that.
2021, I think, 2022.
22, I think. I was in Miami.
When they collapsed, it didn't have, people thought, oh, it's the first domino amongst many. But that wasn't true. What we found out is it was a really poorly run bank who took too many risky bets with their balance sheet. So their liquidity dried up, but it was absorbed by the greater financial system. Banks like JP Morgan, banks like Bank of America stepped in, basically divided up the bank's assets, recapitalized it, and now they just have a bunch of new branches all around California.
Yeah.
So sometimes it can be very micro, and it feels bad. If you banked at Silicon Valley Bank, it was a very tough couple months. If you own Silicon Valley Bank, it was a very rough couple months. But if you were anyone else in any other bank diversified around, it didn't affect you at all.
Not yet. But so I guess where we're going to this with and why I brought up liquidity as opposed to inflation, because we've spoke of it, is there are some alarm bells sounding. There's some concern out there about global liquidity. So it's the idea that the global markets do not have as much liquidity. We've seen the New York Fed met a month or so ago and stated that there's big drops in liquidity. They're episodic, they're sharp, and they're calling it mirage liquidity. It looks like there's a lot of liquidity out there, but there's not all the time. Partly it looks like that way because of the way that trades are now done in a different way, or the way that the markets are done. All of this stems back to the fact that our economy is under stress, and the global economies are under stress. And I think it's something, you and I come on here and we ham it up and make a lot of jokes a lot of times.
Yeah.
And I'm not saying, hey, we need to now be concerned, but this is a more serious conversation that we're having about global liquidity and something that's on our radar.
Sure.
And one of the biggest, and how that I think reflects what's happened over the last decades in terms of creating more debt in the United States.
Yeah.
So first of all, because this is a complex issue, I would ask you to give the TLDR, the real high level answer to kind of explanation of that. And then let's go deeper.
Yeah, definitely. I mean, at its highest level, governments around the world, United States included, the EU, China, et cetera, they all finance their operations through debt, right? So they spend money, right? There's government spending. That spending is done with tax dollars first. They run out of tax dollars, they go to the central bank, the treasury, they create new money, and then they loan that out, right? And so one of the big problems that we faced as a global economy is as debt financing became the preferred tool of growth, every country, every developed country now has a massive amount of debt on their balance sheet, right? So one of the things I talked about earlier was really your balance sheet kind of determines how much you're able to lend out. If your gross domestic product, the value of all your assets, the value of your ability to generate new money doesn't grow faster than your debt obligations, you all of a sudden end up as like someone who can't pay off their credit card because they're getting eaten up by their minimum payment.
Yeah. Yeah. So you have more debt than you have income.
Exactly.
That becomes
Very
a
simple problem.
That becomes a simple problem.
Yep.
And where we're at now as an economy within the US and many industrialized countries is we don't have the growth. Growth is not a simple thing.
No.
Growth, the type of growth that China reports happens because China is an up and coming and developing country, or continues to has all these different areas or other countries, but we're kind of always gonna, in the foreseeable future, we're 2 to 3% GDP.
Yeah, we're kind of at inflation, right? We kind of say, okay, there is a natural increase of the value of goods over time, right? As new things are developed, as new things are invested in, and our economy is probably just going to grow at that for the foreseeable future because serious structural changes have to occur. Like at one point in the United States, you couldn't get past the Appalachian Mountains, right? At one point, the United States couldn't get past the Mississippi River, and now we build railroads. That created a huge industrial boom. All of a sudden, you could live in the desert, right, to dig wells. Those kinds of industrial changes are really behind us.
Well, I think we could even go to the 50s, post World War II. And so that like this huge economic boom, tons of growth in that 50 years.
Yep. Yeah. All the new corporations that we know today basically started in the 50s or modernized in that period of time too.
And so now maybe AI will give us all that growth.
Yeah, maybe it will, but no one really knows though, right?
It's going to give us growth. I don't know.
Some kind.
I mean, but we do like without the type of growth we have, then we have less liquidity.
Yeah, and so then we have to think of, we have less liquidity because we have a lot of debt. So then we have to figure out how do we tackle that. And that's when we were trying to think of, can we relate this to things people hear on the news? I think, we have to pay off the debt has been something people have talked about, probably all of your lifetime, definitely all of my lifetime. And the idea of paying off the debt isn't just for the virtue of, as a person, you want to be debt free. It's very nice. As a country, you just want to create an opportunity to where you can always put money into the system to support things that need support, right? The government's role with the balance sheet is to support growth by providing liquidity. If we get to a point where we have too much debt and our income keeps going down, we just can't create that liquidity anymore. And, we can cause structural instability from that.
So putting that in supply and demand terms, the more debt that we have out there, the less supply of money we have available to create liquidity, the less money we can put in the market.
Yeah.
And so this is great because we're slashing and burning our government, and this will create more liquidity, right?
Yeah, except it won't. I think you did the numbers earlier. 80% of U.S. spending is in the military and entitlement programs.
Entitlement being Medicaid, Medicare, and Social Security.
Right. Exactly.
It's
social services.
It's around 80 to 85%.
Right.
So cutting a lot of people indiscriminately may make us feel good, may make us feel like I'm doing something.
Right.
But like the example I use is it's like saying, well, I'm just going to do an oil change every year instead of every twice a year or 3 times a year.
Right.
You may seem like you're saving money, but it's not going to work out that way.
It's not going to work out that way. And, really the two ways you tackle this from the Federal Reserve's point of view, and they're kind of the people everyone looks to figure this out because they're the money printer terms is people are like, oh, we'll just lower interest rates, right? Well, the cost of our debt right now is at 4.25%, I believe. So it's at 4.25%. Yeah, that's pretty expensive because it used to be 0. So we're like, oh, just cut rates to 0. Well, the problem is if we cut rates to 0, the government debt number doesn't get different. Our spending liability is still increasing, right? So we're not actually solving the structural spending issue. And on top of that, inflation can go up because now no one has a reason to be like, oh, well, it's expensive to grow my spending. Maybe I shouldn't do it. Right?
Yeah.
So it actually can make inflation come back in another way. So we're at this weird point where something structurally needs to change. We either need to increase revenue somehow, right? Maybe it's new businesses open up, we bring in more money around the world, we tax it, and then we go to spend off debt, or we just spend less money. But we know that's probably not going to happen.
You're reminding me, I think it was Eisenhower who said, I would like just one economist with one hand.
Yeah. Yeah.
Yes.
There's a lot of cooks
A
in the kitchen.
one-handed economist instead of, on the other hand, there's debt. And the other hand, there's interest rate.
Yeah.
On the other hand, it's not an easy problem to solve. It's not a solution or even necessarily a clearly defined problem at this moment.
Yeah.
But it's something that we're watching. It's something that's in the news. We thought we'd give some more information on
Definitely.
it.
It's also really complex.
It is.
This is not an easy topic generally for people to wrap their heads around.
It's not. And I think that's one of the reasons why it's attempting in the political space to make a very complex topic simple. Oh, we'll just fire people.
Yeah.
Like, okay.
I wish.
And like, look, I don't think our government's a highly efficient functioning machine.
Sure.
But I also don't mistake that is really is creating an understanding around a very complex topic, which is lack of liquidity in global markets and U.S. markets potentially.
Yeah, I agree. I think there are greater forces at work in trying to simplify any complex issue to a soundbite is a losing bet, for solving the problem.
JP, what is one thing you are hopeful today?
Oh, I wish credit card rates would come
No,
down.
Sorry, I said that wrong.
Sorry.
Bad question. What is one thing that gives you hope today?
That gives us hope.
Yeah.
Yeah, I mean, there is a dynamism that's going on around the world right now, right? Europe is, and unfortunately, it's being caused by some not great things, right? There's tariff talk, there's wars around the world, but I think a lot of people have been kind of sitting back and watching things go by around the world. The European economy has been essentially in a recession for the last 4 years.
At least.
Yeah, at least. The U.S. economy is, really trying to figure out what's the next big technology because big data didn't really do it. The cloud made money, but it didn't really hire anybody. So I think there's this dynamism where people are saying things are getting tricky out there, and we need to put our collective heads together to solve these problems in a way that hasn't happened in a really long time. I'm interested to see how it plays out, but I do know for one thing, when young people especially get together, they start new businesses, they invest in their education, and they go out and try to make the world a better place, they actually end up doing it almost every time. There's actually not really a period in human history where young people had a dynamism and their country did not improve its standard of living. So that's what I'm hopeful for. We'll see how it plays out. But in the meantime, there's going to be a lot of noise and we're not really going to know what's going to happen tomorrow. We just have to keep thinking longer term and push towards that.
Do you have any questions for me?
No.
None at all.
No. Yeah, I would say that, one thing that I would want you to address is, so we talked about global liquidity, talked about kind of like the movement of money, but is there anything that kind of the average retail investor should think about liquidity? Anything we didn't cover today as far as like, prices of stocks, illiquidity premiums, different assets in their liquidity? Is any of that, do you think any of that would add to kind of what we covered here today?
I think it's essential for investors to understand liquidity in their portfolios. Mm-hmm. There are a lot of advisors who sell private investments,
right?
Or this very fancy hedge fund, or this credit strategy, or this real estate strategy. Mm-hmm. And whenever I hear any of those words, I just think I'm not getting my money back for 10 years,
right?
Which is fine because you can get more back in 10 years. But how much of your money can you actually get to? Because we see portfolios all the time, people with these big firms, and they're so sophisticated, and not in a million years would I put my own money into to lock up 25, 35%. And it completely ignores not only the money that they have illiquid, but then also their business and all the other stuff that they have. And so when you look at the whole structure of it, sometimes we see clients with more than 60, 70% of their portfolio that they can't get to anytime quick.
Yeah.
Now, when we talk to a lot of our investors, we say, make sure you have a couple hundred or 2 years worth of cash on hand, all this stuff. That's all really important.
Yeah.
But when we start to working with investors who have higher levels of financial wealth and are working with these really sophisticated private banks that really know what they're doing, their portfolios are bordering malpractice.
Right.
And so asking questions like, what is my real liquidity? Because I lived through 2008, you did too, in a different, it was a very serious one for you too, but a different type of scenario where the gates on these funds were closed.
Right.
That means you called up the fund and you said, I want my money back. And they
Okay.
said, sorry, Charlie, wait in line.
Yeah.
And everybody was selling their assets. And what they did within these funds is they said, everyone wants their money. So do you think, what did they sell? Their best asset or their worst assets?
Yeah, the one that gave them the most money. So their best asset.
They were selling their best assets for penny on the dollars. And then if you were stuck in this fund, you were stuck with the worst.
You held the bag.
You,
as they would say.
Yes, JP, they held the bag. So that's what I would advise and the liquidity thing. Because as you mentioned, and we said, there's only so much you can do about the global liquidity. But you can look at your own and have some control over that.
Yeah, you have the ability to have a better balance sheet than the Federal Reserve.
God willing.
God willing. That's what you should walk away with.
All right.
Try to have a better balance sheet than the U.S. government.
What do you think of these new digs? I think we're moving up.
It's awesome.
The Jeffersons.
I know.
In
When
here.
we walked in, I was like, I feel like we're in Joe Rogan. It's nice in here.
We'll get you the haircut.
Oh, we got the red drapes. The haircut.
Yeah, we'll get it for you. Cool.
Awesome. Yeah. Thanks so much. Appreciate it.
Peace, man.